Ladies and gentlemen, good day and welcome to GMR Airports Limited, formerly GMR Airports Infrastructure Limited, conference call to discuss Q4 FY'25 results. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. We have with us today Mr. Saurabh Chawla, Executive Director, Finance and Strategy. Before we begin, I would like to state that some of the statements made in today's discussion may be forward-looking in nature and involve risk and uncertainties. Also, recording or transcribing of this call without prior permission of the management is strictly prohibited. I now hand the conference over to Mr. Saurabh Chawla for the opening remarks. Thank you, and over to you, sir.
Thank you, Ryan, and good evening, everyone. I welcome our shareholders, analysts, and other stakeholders to our quarterly 4 fiscal 25 earnings call. The past few weeks have been very challenging for our entire nation, and we need to be mindful of the environment as we navigate the coming quarter. Minor turbulence is part of the journey, but our view about the long term remains intact. Boeing company forecasts India's air traffic to grow over 7.9% annually through 2043. Indian and South Asian airlines will add over 2,800 commercial aircrafts to their fleet by 2043, of which 90% will come from the Indian airlines. Echoing the sentiment, Netherlands flag carrier KLM is expanding its operations by starting flights to Hyderabad in September. Malaysian Airlines also affirmed that the Indian market has emerged as a cornerstone for Malaysia Airlines, ranking among the largest and fastest growing markets in its network, expecting a 14% growth in its passenger traffic flow to and from India in 2025. Efforts are also underway to establish India as a global transit hub. Air India's We Ask campaign aims to attract foreign travelers by offering enhanced connectivity between the UK, Europe, Australia, and Southeast Asia through India, with connection times reduced to about 2.5 hours. Many of these connections will be serviced by Delhi Airport, which also serves as Indigo Airlines' largest base with 250 daily departures. Airports operated by GMR continue to receive multiple rewards and recognitions globally, showcasing how we consistently improve our services while adapting to changes. Delhi Airport, which is the 9th busiest airport in the world as per ACI, was awarded the best airport in India and South Asia by Skytrax, with its global ranking improving to 32 in 2025 from 36 in 2024. Skytrax also awarded Hyderabad with the best airport staff in India and South Asia for the 4th time, with global rank improving to 56 in 2025 from 61 in 2024, while Goa Airport's rank improved to 80 from 92. Delhi and Hyderabad airports have also been winning the ACI ASQ award for the best airport in Asia Pacific with the respective passenger categories for multiple consecutive years. On that note, let me now delve into our Q4 25 performance. Momentum in total income continued with quarter 4 fiscal 25 at INR 29.8 billion, up 16% year-on-year, driven by traffic and growth in non-aero revenues, translating to an EBITDA growth of 19% year-on-year with INR 11.2 billion. For fiscal 25, the total income was up 18% year-on-year to INR 108 billion, and EBITDA increased 22.5% year-on-year to INR 42 billion. EBITDA margin for the quarter was 51% in quarter 4 fiscal 25 versus 48% in quarter 4 24. Loss from continuing operations for the quarter was INR 2.9 billion versus loss of INR 2.1 billion in Q4 24, while that for fiscal year 25 was a loss of 8.2 billion, almost unchanged year on year. This is despite a 27% increase in interest expenses for fiscal 25 and 30% increase in depreciation, both resulting from capitalization of our expansion capex already incurred. Had the final tariff for Delhi Airport been issued by mid-year, our results would have been substantially better. Looking ahead, given the expected traffic increase and tariff revision, our position will only improve from here. Consolidated net debt, excluding the FCCBs of INR 24 billion, which are deep in money, stood at INR 315 billion, increasing by INR 18 billion versus quarter 3 fiscal 25. GAL had raised INR 15 billion in the form of 3-year non-convertible bonds, primarily to purchase the 10% equity stake in Delhi Airport from Fraport, while Bhogapuram availed a subordinated debt facility of INR 3.5 billion for its greenfield project, which is already at an advanced stage of completion. On the operational front, traffic continues to grow 9% year on year and 1% Q on Q growth in Q4 fiscal 25, reaching 31.5 million passengers. This is a number which excludes Cebu. Domestic passenger traffic grew 9% year on year, while international traffic grew 11% year on year in quarter 4 25. International passenger traffic share for the quarter was 25%. Fiscal 25 passenger traffic increased 9% year on year to 120.5 million for the group. With respect to specific airports, during quarter 4 fiscal year 25, passenger traffic at Delhi rose 7.5% year on year to 20.6 million and rose 7.6% year on year to 79.3 million for the full fiscal year 25. At Hyderabad, traffic was up 21% year on year to 7.8 million for quarter 4 fiscal 25 and up 18% year on year to 29.5 million for fiscal year 25. Both these airports handled the highest quarterly passengers in quarter 4 fiscal 25. Goa traffic for the quarter declined 5% year on year to 1.27 million passengers. Our international passengers more than doubled versus last year. For Goa in fiscal 25, traffic rose 7% year on year to 4.7 passengers. As new aircraft deliveries gather pace, we expect strong growth in international traffic and there is latent demand for international travel. Total income of Delhi Airport rose 24% year on year to INR 16.4 billion, driven by traffic growth, increase in non-aero income, as well as income from commercial property development, with EBITDA increasing 42% year on year to INR 5.3 billion. At Hyderabad, total income was INR 5.9 billion, up 7% year on year, with traffic driving this growth. EBITDA was up 9% year on year to INR 3.6 billion. Mopa, or Goa Airport, reported a total income of INR 1,201 million, almost unchanged year on year, as quarter 4 fiscal 24 had some CPD income arising from signing hotel agreements. The airport continues to report positive EBITDA in its initial years of operation, with quarter 4 fiscal 25 at 253 million, despite a full quarter impact of revenue share kicking in. Notable achievements during the quarter are: non-aero revenue at all our airports was stronger in the quarter. Combined non-aero revenues at Delhi, Hyderabad and Goa airports rose 13% year-on-year, both in quarter 4 and for the full fiscal year 25. Duty-free SPP at Delhi increased to INR 1,010 rupees in fiscal 25 from 997 rupees in fiscal 24, while Hyderabad SPP was INR 727 in fiscal 25, up from 683 rupees in fiscal 24. The traffic order for control period 4 for Delhi Airport was issued by AERA, and new tariffs have been effective from 16th April 2025. With this, the Aero yield per pax, or YPP, should now be close to INR 360 rupees versus 145 rupees prior to the order. This also should drive a significant improvement in Aero revenue, overall profitability and cash flow generation at Delhi Airport during the current fiscal year. The share purchase agreement with Fraport towards the acquisition of Fraport's minority 10% equity stake in Delhi was concluded in the quarter, thereby increasing GAL's stake in Delhi to 74% from earlier 64%. This was done at a deep discount to what the analysts have been valuing Delhi Airport. Moving forward in its strategy towards consolidation of stakes in existing assets, Hyderabad Airport entered into a share purchase agreement to acquire 70% stake in ESR GMR Logistics Park Private Limited from other shareholders at a consideration of INR 413 million. The airport's wholly owned subsidiary, GMR Hyderabad Aerotropolis Limited, already holds 30% stake in EGL PPL, and with this transaction, EGL PPL will become a wholly owned subsidiary of the airport. Progress on developing the airport adjacency business continues. We are steadfast in long-term strategy of converting GAL into a consumer business with the underpinnings of a utility company. GAL will start operating the Delhi duty-free concession from July 25 and will also take over the operations of duty-free at Hyderabad Airport in quarter 2 of fiscal 26. Very recently, GAL has been granted the concession to operate, maintain and manage the existing cargo terminal at Delhi Airport on similar terms to ensure continuity of operations post the termination of security clearance of one of the cargo operators, resulting in cancellation of that concession. Overnight, GAL had to take over this concession, thereby ensuring seamless transition and no disruption of services to customers. Construction of multiple airport land development projects are underway at all airports. As of March at Bhogapuram, 69% of physical progress is completed, and we expect the airport construction to be completed by December 2026. At Crete, 48% has been achieved, with our target completion date being February of 27. Credit ratings of Delhi Airport were upgraded by Standard & Poor's to BB from BB-, by Fitch to BB+ from BB-, and by ICRA to AA from AA-. The expected improvement in financials in fiscal 26 will further improve in ratings and costs further. At Hyderabad 2, Moody's upgraded the credit ratings from BA1 to BA2. At GMR, we firmly believe that integrating ESG principles is crucial for airport operators to build resilient operations, mitigate risks, and secure a license to grow within evolving regulatory and community expectations. Delhi Airport released its Sustainability Report 2024, a comprehensive disclosure that sets a new benchmark for climate action, innovation, and social impact in the Indian aviation industry. The report outlines airport's transformation journey in embedding sustainability to the heart of its operations, making not just India's busiest airport, but also its greenest. Key highlights of the report are: Delhi Airport became Asia's first Level 5 carbon accredited airport in over 40 million passengers per annum category. Delhi Airport continues to operate entirely on net renewable energy. Over the last 4 years, the airport achieved a 52% absolute reduction in carbon dioxide emissions and a 36% in carbon dioxide emissions per passenger. Infrastructure projects like Eastern Cross Taxiway and deployment of taxi bots and 22 new bridge-mounted equipment have dramatically cut aircraft taxiing time, fuel usage, and greenhouse gas emissions. Delhi Airport is on track to become a water-positive airport. Through the GMR Varalakshmi Foundation, Delhi Airport is actively uplifting the underprivileged communities across the National Capital Region. It recently implemented a hidden disability sunflower program, making Indira Gandhi International Airport a sunflower-friendly airport with personalized support for persons with non-visible disabilities. The report is available on Delhi Airport's website, and I would encourage you to read the report to appreciate Delhi Airport's initiatives and actions on the ESG front. Hyderabad Airport achieved a Level 5 carbon accreditation under the globally recognized Airport Carbon Accreditation or ACA program, placing the airport amongst the top 4 airports in ACI, Asia Pacific and Middle East region. Goa Airport won Build India Infra Awards in 2025 for sustainability in civil aviation sector. Our IR presentation with all the financial numbers are already available with you. If not, you can download it from our investor relations section of our website. We are available to respond to your questions on this call and offline after the call. Now, I would like to open the forum for queries that can be addressed by my colleagues from the corporate and the business teams. Thank you so much.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Yeah. Good evening, sir, and thanks for the opportunity. My first question is, sir, can you please explain the impact of Delhi tariff order expected on the annual revenues of the DIAL?
Mohit, we don't give forward guidances on revenues. Obviously, the new tariff order.
Tariff, yeah.
So the new tariff order, we can talk specifics on that aspect of it. Yeah, Siddharth, why don't you?
Yeah, the current the tariff was 145 rupees yield per pax. Now the revised tariff, which is now implemented from 16th April 2025, is 360 rupees yield per pax. That means there is an increase of 215 rupees yield per pax. So basing on that, you can do the calculation. If it is 80 million passengers, it's about 1,600 crores will go off.
Understood, sir. My second question is on the depreciation interest. Of course, the interest has seen a sharper increase YOY and QOQ. is this 9 billion number, quarterly number, is this a number, or 9 or 10 billion number, that's the number which we should work with for the F'26? Is it a fair assumption?
It is increase in the interest cost and depreciation on capitalization which has been completed last year. This is on a yearly basis. This will be more or less the final depreciation and interest cost.
Is there scope for reduction in the interest cost as you go forward? This number looks to be sitting slightly higher side.
No, there will be some reduction in interest cost because in case of the Delhi, there is one of about 80 crore rupees of charge because of the cancellation of the hedges, and that will not be there going forward. Further, since we have refinanced nearly 2,500 crores in case of Delhi, about 12% rate of interest to 9.5, so there will be some more saving. So going forward, there will be some reduction in case of the interest cost.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. We take the next question from the line of Karthik Challappa from Indus Capital Advisors. Please go ahead.
Yeah, hi. Good evening, sir. Thank you very much for the opportunity. Three questions from my side. The first one is on Delhi Airport. If we look at the CPD rentals this quarter.
Can you speak, sorry, can you come closer to the mic, please? We can't hear you very well. There's a little disturbance also now in the...
Sir, how is this one, sir? Is this any better?
Yeah, this is much better. Much better, much better.
Okay, excellent. Yeah, thank you for the opportunity, sir. I have three questions. The first question is, if I were to look at our CPD rental income for Delhi Airport, against a run rate of about 200 crores for several quarters, this quarter we have seen a sizable bump up to about 383 crore. What has actually driven that, and what is a steady state kind of CPD rental that we can actually expect going forward?
Okay, this quarter, one of the asset which has been leased out in case of the CPD land, now all the CPs have been completed. Hence, India's 116 lease financing has kicked in. So we have equalized all the MMGs which have been receivable over a period of next 46 years. As a result, there is a bump of about 188 to 190 crore rupees this quarter. And going forward on a yearly basis, there will be an increase to the extent of about 120 crore going forward.
Okay, so from here on, the steady state should be somewhere about 3 to 3.2 billion per quarter, right?
No, 120 crore rupees increase going forward on a yearly basis.
Oh, okay. So 1 to 2 billion increase on a yearly basis. Okay, great. Thank you. My second question, sir, is now the FY'26 will see the first year of the full effect of the new YPP. So I don't mean it in the form of a guidance, but if I were to just do a basic math of keeping all other things equal, our aero revenues will now more than double. And if I keep our interest, depreciation, everything constant, is it reasonable to assume that FY'26 Delhi Airport should be able to break even?
I think that would again allude to guidance. I really don't want to, give that, forecast to you. But there is a significant improvement. If you look at the Delhi duty-free, the Delhi Airport's P&L, and if you impute the numbers that you're articulating, I think the results will be quite obvious over there.
Okay, great. My last question, sir, is on Hyderabad Airport. What we have seen is this quarter, there has been a sequential softness in the EBITDA margins for the Hyderabad Airport. And the effective tax rate this quarter has also been very high, almost about 44-45%. So could you please clarify what led to the sequential softness and also the effective tax rate?
Just one question. Just 1 minute, please.
Sure.
Karthik, if you adjust this with respect to other income, you will see an improvement in EBITDA margin is mainly because in Q4, the other income is lower compared to Q3. That's the main reason.
Okay, because even if I adjust the other income, even if I exclude it, there seems to be a reduction. So that was why I was curious to see whether there was anything else apart from other income.
No, there could be some year-end expenses.
Year-end expenses have been booked. Some of the expenses which have come around 10 crore rupees extra, which has been accounted for. And as far as the tax is concerned, it is only in a book entry, and we actually take MAT credit back into the books. Hyderabad airport is not paying any taxes
As of now.
Got it. So which means the steady state tax rate, I mean, it's not paying any taxes, but the steady state tax rate should continue to be about 33-34% then, right?
No. This is actually what we have accounted for is only a MAT. It is not full tax.
Okay.
We are under MAT because we have a carry forward losses available under income tax.
Okay, excellent. Just one follow-up, sir, if I may, to your earlier the comments that you made at the beginning that the economic environment had been a bit volatile in the first 2 months because of the developments recently. Has that had any impact on your volumes or your forward bookings in the short term? And if yes, how long do you expect that to last, whether it is in Delhi or in Hyderabad?
Basically, you are talking about the
India-Pakistan and the impact on the traffic. So honestly, it's a very minimal impact on traffic. It was only certain airports north India to be shut down during those operations, during those 7-10 days. A minimal impact in the size of operations at Delhi. Hyderabad, almost no impact, and now we see a comeback even in those jurisdictions.
Excellent. Okay, that's it from my side, sir. Thank you very much and wish the management team all the very best for FY'26.
Thank you. We take the next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Hi, good evening, sir. I have a few questions. Firstly, on RE, this CPD income jump. So we are implying that our annual CPD income at Delhi will jump from around 800 odd crore to 930 odd crores going forward annually. The right assessment. Also, related question, what is the timeline of other RE projects which are going to commission, including Bharti Realty, starting to give you these rental and other projects, including the destination mall which we are building in that location?
Yeah, Prateek, I have here Aman Kapoor, who heads our CPD business over here, so he will guide you on developments in that business. Aman.
Yeah. So, respect to Bharti, in the first phase of the 5 million square feet FAR that was granted, the almost 55% of people will get ready and commission by third quarter of this calendar year. That has no impact on revenues per dial because there is no revenue share and the fixed land rentals are continuing to be paid. So it has no necessarily an economic impact. With respect to the shopping center, it is expected in first quarter of 2028 to start operations. The from this financial year onwards, the minimum guaranteed rent has kicked in, and that will continue to be paid irrespective of whether the project is completed or not.
So that's what the straight lining, which GRK Garu had highlighted, explained earlier.
And the Bharti phase 2 when is that supposed to come in picture in terms of rentals contribution to the company? Dial?
Well, they have a right to choose up until end of I think it's the year 2027. They have a right to exercise that option.
So from FY'28 onwards, we should probably build that number.
Yes.
If they exercise that option, correct.
Then the rentals will start kicking.
My other question was regarding Delhi duty free. We have given this data on annual numbers for the big entities, duty free, cargo, etc. That shows that EBITDA and PAT for the financial year 25 as 340 crores and 205 crores. That seemed to be suggest a very small growth year on year, like basically compression of margins and like almost a decline in PAT, while the top line seems to be growing well. Why is that specifically?
Yeah. This is basically, if you look at it, 23-24 financial year compared to 24-25, you are looking at it. In 23-24 financial year, FY'24 ending, the duty free was getting the refund of ITC on both arrival and departure stores. So they got a benefit about 50 to 60 crore rupees. Whereas the government has withdrawn on arrival store and they are allowing only on departure store the ITC credit going forward from October 2023 onwards. As a result, if you compare 24 and versus 25, even though turnover has gone up, because of that ITC credit not available in 24-25, that's come down.
So it's just a 4% impact.
4%.
So it's a sustained impact. So is this below EBITDA or above EBITDA line item?
That was above EBITDA line item.
Okay, so your top line has grown 14%, EBITDA has grown 3%, and PAT has actually declined by around 10% in FY'25 in this segment. So that's why the question was there. So I'm not sure if it is this completely explained. So there are like line items below EBITDA also, which explains the PAT performance.
No, below EBITDA, there are no issues. So the below EBITDA is basically the last year profit versus this year profit. Profit has come down mainly because of the ITC refunds, which they used to get. They used to put less cost in 23-24, whereas 100% cost has been accounted for in 24-25. That is the reason why at EBITDA level it has come down and compared to 24 to 25. And going forward, that will be the final.
Yeah, so Prateek, your EBITDA margins in your duty-free business will be about 15 to 17%
Going forward.
Taking into account this one-time adjustment of withdrawal order from the government. This was as against a 20% EBITDA margin earlier. So from your modeling perspective, you should assume about 17% EBITDA margin.
Sure. And lastly, on net debt has now touched 31,400 crores in this quarter. How do you see net debt in FY'26 from here, and what is the capex expectation in FY'26 for the overall operation?
There will be addition because the Bhogapuram construction is happening. If you look at it in the 31,000 crores, the Bhogapuram is accounted for only 1,400 crores, 1,500 crores. So we will be drawing additional 1,700 crores in this 25-26. So to that extent, the debt can go up further. And GAL level also, we have raised 400 crores in April and we may likely to raise another 200-300 crores in this financial year. So about 700 crore rupees also GAL level go up. So total about 17 plus 7, 2,400 crore rupees can go up.
This is the gross debt, but net debt, because your EBITDA cash accruals will also increase significantly because of tariff benefits in DIAL. So net debt can continue to go up, or like that may have peaked in FY'25 and.
So net debt will also go up slightly, but not as much as the gross debt is because of the cash accruals, because of the enhanced tariff that we have now in place.
The DIAL will throw a good amount of cash because of implementation of the tariffs. So that cash accrual will be there. Gross debt may go up by around 2,500 crores, but net debt may not go up that much.
Sure. I'll get back to you. Thank you.
Thank you. The next question comes from the line of Dario Maglione from BNP Paribas. Please go ahead.
Hi, good afternoon. Thanks for allowing me to ask you some questions. I have two, if I may. One is on the Noida airport, just outside Delhi. It should open in the next few months. So are you seeing any impact on airline scheduled capacity for the new Delhi airport? And question number two is on actually Group EDP. As you know, the CEO has changed at the beginning of the year, and on the full year results call, the CEO mentioned that one of the pillars of his strategy is to get basically dividends from international assets, including GMR airports. However, he also mentioned previously that there is a lot of opportunity to invest in India. So within this context, when do you think that GMR airports will pay dividends? Thanks.
Yeah, so on Jewar, honestly speaking, the opening of that airport is quite complementary to our Delhi airport. Delhi airport, as you know, we have expanded our capacity to about 100 million passengers, and there will be, we would actually encourage some of the low-yielding traffic, and when I say low-yielding traffic is, the ATRs and some domestic traffic which does not spend too much at my airport to move over the next 3 to 4 years. It's not going to happen immediately, but next 3 to 4 years is what we expect that to happen, which is beneficial because my international traffic is growing quite robustly, and that will release the capacity at the airport on the air side of it for the aircraft movements. So it's very complementary for us that Jewar will open. The market itself is growing almost 8 to 10% every year. There is enough for everybody. From a competitive scenario, Jewar Airport is almost 70-80 kilometers from.
Ladies and gentlemen, we have lost the line of the management. Please stay connected while I rejoin the management. Ladies and gentlemen, we have the management reconnected. Dario, if you can please repeat your question. Thank you.
Yes, hi. So I think to answer the question on Noida, you were mentioning that Noida Airport is 70 to 80 kilometers away, I guess, from the center of Delhi.
Yes. So, purely from a distance perspective, it doesn't serve the main Delhi and Gurgaon, clientele. Even Noida clientele, it doesn't service. It does service the greater Noida, and the catchment area for that is mostly Agra and Aligarh areas, which are, from an economic standpoint, notch lower than the high-yielding passenger traffic that we have from Delhi, Gurgaon, and also other northern parts of India. So We expect that, as time goes by and over the next 2 to 3 years, as our traffic also starts to, or capacity starts to reach about 100 million passengers, we expect some of the low-yielding passengers to continue to move from Delhi Airport, and we concentrate on the high-yielding passengers, which are usually the international traffic of full-service airlines. So that's the strategy. In nutshell, Jewar is very complementary to our business model, and as we go forward, we will continue to work with airlines to facilitate, their slots over here at Delhi Airport. I just want to highlight one aspect that airlines don't give up slots. They once they get hold of slots, they hold them very, very dearly. But yes, on the low-yielding ones, we would encourage these airlines to move to Jewar. On ADP, sorry?
That makes sense. Thanks.
Yeah. On ADP, just want to again highlight, Philippe Pascal has taken over as the chairman and managing director of ADP. Philippe was the CFO when we did the transaction in 2020, and he was one of the persons who negotiated with us. He fully understands the spirit behind their investment in GMR Airports, so we have a very strong relationship with the current senior management. Many of them have also worked for a brief period of time at GMR Airports here in New Delhi. So from a transition perspective, we don't expect any turbulence. There's total alignment of strategy and objectives between Group ADP and GMR as far as the GMR Airports business is concerned. With respect to dividend outlook, we have always highlighted that we should be achieving, on a consolidated level at GAL, free cash free, FCFE positive status by fiscal 28. And the prerogative of giving dividend, of course, is with the board of directors. I really can't speak for them. All I can highlight to you is that purely from a cash flow perspective, going forward from fiscal 28, GAL would be in a position to give dividends as it goes forward. So we will, of course, guide the markets as we reach that milestone. But that's what our thought process is, that GAL should be a dividend-paying entity for its shareholders. As you would have seen during last fiscal year, Hyderabad Airport has already declared 2 dividends which have come to GAL. With the new tariff order, Delhi should also start giving dividends after 3 years, and hence, we believe that also by that time, the transition of the non-aero businesses into GAL would be mature enough, so enough cash flow generation would have happened would have started to happen at GAL, facilitating any outflow of dividends from fiscal 28 onwards. That's my, guidance.
Okay. Thank you very much.
Thank you.
Thank you. The next question comes from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Yes, thank you so much for taking my question. So my first question is, now since the cancellation of the Celebrity Delhi, who is managing it? Is it DIAL or is it GAL? And what are the revenues and PAT that for FY'25, and what can we expect for FY'26?
Yeah. So this is being managed by GAL now, in terms of concession being taken over by GAL. And in terms of the revenues for FY'25, they clocked about 780 crores and with a PAT of 120 crores. For FY'26, this will be a forward-looking number, so maybe I'll not talk about that, but you can assume reasonable growth over the numbers what I've just told you.
All right. And the Delhi duty free, could you tell me what the revenues and PAT are for FY'25 if I missed it, if you mentioned this time?
Delhi duty free FY'25 clocked with revenue of 2,200 crores, with a PAT of about 210 crores.
All right. And lastly, just that the Hyderabad airport duty free, has that moved from GMR hospitality and retail to gas?
It will, yes, it started moving into the GAL, and full-fledged operations will be started by GAL from July 25.
All right. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. The next question comes from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Good evening, everyone, and thank you for the opportunity. My first question links to the growth we've seen in recent months at the Delhi airport. It started becoming more like a 6% kind of trend. Could you give us a sense of why growth appears to be kind of slowing down in these months, March and April? Because I would want to assume that, like Hyderabad, capacity is only expanding. And could you give us a sense of how to kind of then think through a reversal in growth happening in Delhi?
In case of the Delhi, I think March has clocked very well, and April. Since the base is very high, the Delhi always growth is between 5 to 6%, maximum 7%. When it comes to Hyderabad, the base is very low, which is about 24 million. It has achieved 29 million. The growth is 17%. And as far as the capacity is concerned, Hyderabad has been built for 34 million capacity, and it has closed with 29 million this financial year. Next year, we are expected to touch about 32 to 33 million.
Understood. So essentially, Delhi should be on this stable 5-6% growth pattern from here on, given the higher classified.
Yeah, between 6 to 8% is the growth you can assume at Delhi Airport, given the fact that today we are doing almost 80 million passengers.
The base is so high.
Yeah. It's not a capacity issue right now, right? It's just the way that the is panning out in recent months and things made slightly better. I think that's the
Also, Aditya, capacity is already gone. The airside capacity is fully completed. It's actually, we don't have to put in any capex to increase the airside capacity. The airside capacity will only now increase due to technological improvements for better, ATM management. Okay, it can go up to almost 140 million there. Okay, but for that, you have to continuously work with the regulator, which is DGCA, to improve the software and other equipment over there. On the city side is where we have 100 million terminal capacity as on date. We can sweat these assets to take it to about 120 million. And if we reach that level, it's good news for all of us. And if we need to put some capex to further enhance the terminal to balance the capacity, we will do it at that point of time. So now it's only a question of passenger throughput, and for that, the best guidance you will get, at least in the listed space, is from Indigo. And I think I read today there was some news reports of Indigo that almost 80 aircrafts which were grounded are coming back over the next 6 months with their Pratt & Whitney engine issues getting resolved. So as the aircraft supply increases, the supply side will get debottlenecked, and obviously, Delhi being almost 30% to 40% market share in India, that will also flow through Delhi. And last but not the least, will have a positive impact on fares, which will again put some tailwind on the demand for flying.
Understood. That clarifies. The second question that I had was that, again, trying to kind of pick your brains up. See, you said 13% is a non-aero growth for the three aggregate assets in the fiscal, and about, I think, 10% is the growth in tax count. So it's about 1.3 times that is happening in terms of growth, and obviously inflation and insights. It doesn't seem as if beyond inflation, any other meaningful factors that should be driving the performance, penetration, premiumization, so on and so forth, is helping us right now. How soon should we be expecting more than a kind of a 3% differential in non-aero revenue growth versus the tax growth for the three assets that we have?
Yeah. So Aditya, if you would have seen even in the past, our growth of SPP, which is growth over the normal traffic growth, has been in the range of about 5%. And that is like, with the available space and all that. As we will go forward, and you would have seen in case of Hyderabad airport duty-free business, the SPP growth has been significant. This was with the expanded area with the new offerings. So our focus is on three count. One, how do you get more space to cater to the additional offerings? That's one. Within our given space, how do you bring in premiumization? So what we are doing is in Hyderabad, we are bringing in bridge to luxury segment, as part of our retail offering. Similarly, on the F&B side, we are bringing in Michelin star restaurants. So those are the steps which are being taken to bring in premiumization of the offerings, more space, and also basically bringing in the differential product offerings here. So I think that's something which is now the focus and which will be driving our further growth beyond what you generally call it as a Hindu rate of growth for SPP.
Also, Aditya, I think you need to take into account as the concession of the previous concessionaire was ending, obviously the focus was more on the transitioning aspect rather than on the growth aspect of it. As it comes back to GMR airport fold, full efforts will be there to put the necessary investments, both from area space perspective, brands perspective, to take it to a different level.
Understood. Third question that I had was on the part beyond the three airports in terms of revenues and EBITDA. And thank you so much for providing color in the presentation to the extent that you have. It's very helpful. The way I see through it, the additional EBITDA beyond the three assets is coming in from two buckets. One of which is very clear, the subsidiaries of yours, the aero, the hotel, the duty free in Hyderabad, parking in Delhi. The other half is being clubbed up inside GAL standalone as an EBITDA. And by the way, this is a fairly high EBITDA margin business that is getting clubbed up. Could you give us a sense of this second bucket and what were key drivers? I mean, how should we be taking through growth in this fairly large EBITDA item, which is all clubbed up for now? Clarity would be useful.
Basically, in case of the GAL, the revenues are, we call it, put it in three buckets. One is basically the management fee and operator fee which we collect. The second one is the interest income where they lend. The third one is adjacency business non-aero, basically four verticals. One is the retail, other one is the cargo, third one is the car park, and fourth one is the duty free. So now all those things have started showing in this current financial year in GAL, which are likely to grow substantially going forward, especially duty free, where we are taking over the Delhi as well as Hyderabad duty free, so which will start operating from July 2025 onwards.
So, in nutshell, I think what GRK Garu is highlighting to you, Aditya, is that this is mostly management fee, dividend earned from Hyderabad, and interest earned from loans extended to its subsidiaries. That's the component that today that bar represents. But as the transition happens of the non-aero businesses, this component as relative to the growth of the other component will slowly come down.
Yes.
And operating income will substantially go.
So operating income in the FY'26 can go as much as more than 2,200 crores.
From the existing 800-900 crores that is there, maybe in this bucket at this point of time. Now, just wanted to kind of clarify, will you be adding in the next year Delhi duty free to GAL? You will be adding Delhi cargo.
Yes. From July onwards
to GAL? Yes.
That's correct, sir.
Okay. I'm just trying to kind of... Yeah.
Delhi duty free, Hyderabad duty free, both will be operated by GAL from July 25th to July 2025. That's what I said. This current financial GAL has closed with a turnover of about 1,200 crores with EBITDA about 600 crores, which will substantially go up the next financial year because of adding of the duty free business. And EBITDA also will substantially.
And in this credit, are you also counting in Delhi cargo and the Hyderabad warehousing venture where you have aggregated stake? Will they be over and above 2,000 crores?
Aditya, sorry to intervene. There are few other participants also in the queue. Would request if you can come again in the queue.
Works. Thank you so much for your response. Thank you.
Thank you. We take the next question from the line of Karthik Chellappa from Indus Capital Advisors. Please go ahead.
Yeah, thank you for the opportunity again, sir. I just have one question to a comment that you had made earlier, that you expect the gross debt to still go up by about 24 billion, split between Bhogapuram, which would be another 17, and another 6 to 7 at the holding company level. So am I correct in factually?
Yes, correct. You're absolutely right.
Okay. So just one question on that. Number one is Bhogapuram is already 69% complete. In other words, almost more than 2/3 complete. And if I look at the net debt on Bhogapuram, it's already about 17 billion. But if we are borrowing another 17, it's almost doubling the borrowing there for an additional 30%. So how do I reconcile that?
No, the physical progress we are showing, but the billing has not happened from the contractors. So we continue to pay them as and when the bills have been received. There will be always a lag to the extent of 300 to 400 crores in payment. It is not because we don't have the money, because they take more time to submit this. Number one. Number two, the total debt for Bhogapuram Airport itself is 3,215 crores. That means we have raised about 1,500 crores. Another 1,700 crores we have to raise to complete the project.
Complete and pay all the
And excellent. One last question, sir. On the holding company debt, where you're raising another 6 to 7 billion, what would that be employed for?
Basically, about 250 crore rupees is the deposit which we have to give to TIAL for the duty-free business. We also have to make equity investment in case of the Nagpur airport to the extent about 200 crores. And we also have to make another 110 crore rupees equity investment in case of Bhogapuram and other small other requirements. All put together about 6 to 700 crores.
Okay. Thank you very much for this detailed clarification, sir. That's all from my side.
Thank you. We take the next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, thanks for the opportunity again. I have just a couple of questions. Firstly, because of this Pakistan airspace ban and diversion of traffic routes because of that, has there been any instance of some airlines shifting traffic to maybe Mumbai, or do you foresee that happening? And second question is, which is a different question, regarding new concessions. Like government has recently approved few new greenfield projects at Odisha, Kota, and I think Chennai Part 2. So how are we looking at these concessions coming up?
So typically, I'll just say that there is no movement of traffic from Delhi to other airports because of the airspace having got shut by Pakistan. And now actually, most of the foreign airlines are now operating. They started to operate through Pakistan airspace. Indian-owned airlines are not, or Indian flag airlines are not operating. So there was no movement away from Delhi. So that is one feedback.
On the part of the new Chennai second airport and other opportunities, so these are the projects which we look at on the merit of it. And as and when those processes are launched by the government, yes, we definitely have keen interest in all opportunities in India, but it should be value accretive to the shareholders. So those will be evaluated and considered on the basis of merit of that opportunity.
Thank you. That's
Again,
it from my side.
Again, Prateek, very simply put, today I'm at about 120 million passengers, growing at about 8 to 10% every year. I want to make money on the investment we have already done. I am under no pressure, obligation, for optical reasons to have more airports under my belt. As a preference, we like to put more money to work in greenfield airports. Let's see what the terms and conditions come for these greenfield airports. But we are hungry for returns. We are hungry for dividend, and we will grow our current portfolio to whatever levels of capacity that we have created. So that's the only guidance I would like to give to you.
Thanks for the clarification.
Thank you. Ladies and gentlemen, we take that as the last question and conclude the question and answer session. I now hand the conference over to Mr. Saurabh Chawla for his closing comments.
Thank you. Thank you, friends, for joining us on this quarter 4 fiscal 25 and annual results call. I hope we have been able to satisfy all your queries. But in case you have any further questions, the IR team is available offline, both through email questions or by having a call with them. I urge you to contact them and clarify your questions, and look forward to meeting with you very soon. Thank you so much.
Thank you. On behalf of GMR Airports Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.